Hi, my name is Ben Reppond. Today is December 20, 2022. Welcome to my YouTube broadcast. Today I'm going to devote the entire broadcast to the stock market, the view of 2022, and looking ahead to 2023 and tell you what I see and why I see it. 2022 has been a challenging market. It has been challenging from an investor perspective, whether a person invests in bonds or stocks and bonds, any combination thereof. It's been difficult. They have both declined significantly at different times in different ways, but it has generally been a down market. We're a tactical manager, so on the tactical side, it's been a challenge for us. We did really well. We protected a lot of risk during the first half of the year, and you could even say the first 9 months of the year, but the fourth quarter has been our biggest challenge. And as a result, what we've done is learn from this, and particularly what we learned in the fourth quarter, try to adapt so that whatever happens in the future, we're hopefully more prepared for it. And we have tightened up our methodology a little bit on, particularly on defense. So I think we're facing a very challenging market in front of us. And if so, with our emphasis more than ever on defense, I think that will, I think it's going to work well for us going forward. But I'm part of a community of investment advisors who participate on institutional platforms. And in my conversation with them, everyone has struggled, every one of them. And these are people who are very seasoned, very professional. They invest on institutional platforms. And I won't name any names, but I can tell you that one of them that I know of is down 30 to 40% this year, and who is a very seasoned, very well-respected investment manager, and it has just not worked well for him. So anyway, it's a challenge for everybody. So if you're an investor, you probably are. If you're an investor and you do it yourself or you use an investment manager, yeah, it's challenging for everyone, I think. So I'm going to put this together and talk about what do we see going forward. Last week, I showed a piece from CNBC where Melissa Lee interviewed Mike Wilson, the Chief Investment Officer of Morgan Stanley, and he very well articulated the view of Morgan Stanley, or his view, that he believes that the market will experience a decline, a further decline, probably, he says, in the first quarter, maybe second quarter, because earnings are the slowdown in growth in companies is starting to impact earnings. And we've not seen that much this year, but he thinks it'll start to show up in 2023. That's an opinion, so they have their own estimates of what they think that will be, and because of that, they think that the market will drop. Okay, that actually makes sense to me. I don't know in what order, he didn't either. But he said from there, he used some numbers, and he said, you know, from the day he said it, he said that would mean I did the math, represent a decline of another 15 to 25% in the S&P 500. And from the beginning of 2022, that would represent a total decline, roughly, of about 30 to 40%. And that sounds about right to me. From there, he inferred that the market would rally and go back up to about where it started, not this last January, but here sometime in December, and that would represent a pretty big rally, right in the midst of the economy being not doing well at all. And so sometimes the market becomes disconnected from the economy. They don't, one goes in one direction, one goes in the other. I did showed you the chart from the Great Depression, where there were, in the heart of the Depression from 1932 to 1937, 3 rallies, and the economy could not have been worse. Matter of fact, it has never been worse in the United States, and these 3 rallies have never been greater than in the depths of the Depression from 32 to 37. A 78% increase, a 100% increase, and another 100% increase. And the first 2 came within, achieved that in just a few month period of time. Really unheard of. So that's an example of how the market becomes disconnected from the economy. So when the economy goes down and the outlook and everything that you see, and I'll play some clips, you'll see everything that is being put out there from housing, unemployment, interest rates, inflation, slowdown in sales, earnings, etc. Everything that you use to measure stock performance is negative. And yet it gets to a point where it becomes incredibly positive for the market. And that makes no sense. I've seen this happen many times over the last 20, 25 years. And whenever it happens, you shake your head and go, I don't understand it. But that's what the market does. It gets to a point where buyers come in and push it up, and the sellers are pretty much exhausted. So there's no selling pressure, and all there is enthusiasm to buy. Completely disconnected from the economy. So I want to say that what Mike Wilson said or inferred was that we will see both of those at least once in 2023. So we may see them twice. We may see one of them once and one of them twice. We don't know. But I think we're going to see that. He went on to say that 2023 is probably going to be a good environment for tactical investors, tactical managers. That's what we are. I believe that in 2023 we are fully set to take advantage of risk protection on the downside, and I think we'll get plenty of opportunity for that, and we'll fully participate, or at least as much as possible, on the upside, and I think we'll see plenty of that. In some order that none of us know at this point. So that's my take on it. I want to begin with an interview from Scott Wapner from CNBC, and he interviews Joe Terranova and Steve Weiss and get their take on what they see happening for 2023. Take a listen.
S&P's down 60, 1.5% as well. You get the picture here. 349 is the yield on the 10-year. Joe, wondering if this is the week that ruined the end of your rally. Questions about whether falling bond yields could actually help stocks. Problem is, not if they're falling for the wrong reasons, because of the economic concerns and recession fears that we have.
Well, let's first address the Santa Claus rally. I think potentially you're getting something better than a Santa Claus rally. The problem is you're going to have to endure a lot lower S&P price for that. And maybe that is an interim low as we turn the calendar into January. But clearly, this week, we've seen such a dramatic reversal from the CPI release on Tuesday morning. You've now traced out what's called an outside down week. You've done it in every major index, from the Russell to the Dow Jones, S&P, and NASDAQ. That signals that there is ahead of us in the coming days further weakness. And I think the best thing you could hope for is that some form of an interim low is traced out.
Remember, Joe makes a good point, Weiss. It was this week, Tuesday, CPI, right? Market went up near 800, gave it all back. Fundstrat's Mark Newton, he's their technician. S&P and the Q's breakdown, turning near-term more bearish. More proof of upcoming consolidation in equities over the next week. I mean, we're running out of time for a Santa Claus rally if, in fact, it's going to materialize.
Yeah, as I said last week, the week before, it's getting late very early. So the focus continues to be on a Santa Claus rally, and that's the wrong focus. The focus should be on what Powell is saying, not on what people want him to say, not on the fact you're seeing a tick lower than expected in CPI. You still got CPI 3 times what the Fed wants it to be. So this is going to sound arrogant, and I apologize, but this is the easiest market to analyze that I've seen, except for the time when the Fed went all in and cut rates to 0. The reason being is that you knew markets were going to go up. Tepper came on, told us market's going up. Everybody knew it. Free money. You put on risk. Isn't it the same thing in the reverse? Why don't people want to believe that? That the Fed's going pedal to the metal. They've told you they want to go into a recession. Maybe not in those exact words. And it doesn't matter.
Well, what's the bond market doing then? It's calling you know what. It's calling you know what.
Okay, so I have a choice.
Right?
First of all, I'm short bonds. But I have a choice. My choice is, do I listen to the bond market, which has so many different signals? It's technical trading. It's outside U.S. looking for yield.
But it's been right.
It is right.
It's right in the economy. It's wrong on the Fed. So I'm short bonds because I think you'll see a 4% yield. And if you don't see a 4% yield, I'll be right on my shorts that I have. So to me, the direction is still lower. Forget the public CEOs. Just in San Fran, spent time with a number of private CEOs. We're investing in the companies. They tell a different story. They don't have to be cheerleaders for their company. They got to be realists because they're going to look to come to the market.
What do you mean, though? I mean, the public CEOs are the ones who've been negative.
No, actually, the banks have been. The banks have been the most negative. But if you look at the others, like Adobe today, okay, really positive. You take.
I mean, Adobe stock is up in a down tape.
It is, but I'll tell you what. I'll bet you $1,000 right now I can get it cheaper in 2-3 weeks. Okay? Take a look at Delta Airlines. What they don't tell you, the CEO, saying things are great, we're doing better than 2019, we're going to do better, even better next year. United, we saw the same thing. What they don't tell you is that you can cancel up until that flight leaves the gate. So don't be deluded by what you're seeing today. Look at where the puck's going, and the puck's not going to the net for the bulls. So one more thing, Scott. I keep saying you got to be patient. Long-term investors, you got to be patient. The first tenet of investing money, right, is don't lose it. The second tenet is be patient. Who's being more patient? Bulls who are rushing in and looking for phenomenal opportunities like Adobe today, or the ones who are saying, I'm going to wait for a better price and I'm going to get it?
That was interesting because the outlook from both Steve Weiss and Joe Terranova, especially Steve Weiss, pointed out, how negative he is on bonds in 2023. And of course, 2022 was a disaster for bonds as well. So again, conservative investors, cautious investors, those that have used bonds traditionally, and it's a common tool for a defensive strategy. I think that's not going to work well this coming year, and that's his view of it as well. This is an article that I saw. It came from Al Jazeera. USC's biggest drop in retail sales in 11 months. This came out in the last, I don't know the date, I think it's the last week. And but this is interesting because this follows the, Black Friday. It follows the pre-Christmas shopping. This is the biggest month of the year, and yet they are reporting the biggest drop in retail sales in 11 months. What does that tell us about 2023? If you're from retailers, if you're going to make any money, this is the month to do it, not to report a huge drop in sales. So the implications of this for businesses staying in business, or slowdown in earnings, slowdown in sales, jobs, all kinds of things have repercussions from this. And this is not a forecast. This was actually reported this past week. Then this came from a shipping blog, and it says cargo slowdown continues at Port of Los Angeles. In the text of the article, it reports that cargo coming into the Port of Los Angeles is down 24% from a year ago. I think this was reported as of the end of November. So end of November this year compared to end of November last year, 24% drop. And the Port of Los Angeles would be probably a bellwether indicator for the U.S., incoming shipments to the U.S., and probably exports going out of China in particular, but the Far East in general. I will be playing something from China, but there is a big slowdown there. So I don't know how much this, and I'm just going to say this, I don't know how much is from supply and how much is from demand. I think the demand, as I've said earlier, you could see it is clearly slowing, but that is connected to a supply shortage as well. A friend of mine here, and I'll just leave it generic, the reports that a relative has a business that makes machinery that does provides labels for products. So he doesn't provide labels and he doesn't provide the products. He provides the machinery that makes the labels. Okay. So he's selling to big companies that all kinds of products that you would buy, for example, at Costco or any retailer that has labels. He has machinery that makes those labels. So he has reported a substantial drop in orders. So he has had to lay off a lot of his staff because they don't have the orders to support them. What that told me is that is a forward indicator, a leading indicator for what's coming. If you're not able, again, whether it's from the products that they can get, or it's on the supply side, or it's on the demand side, people just aren't buying them. We don't know. But some combination of those, we've referred to it as supply chain, but we really don't know how much of it is supply and demand. What I do know is that there is a drop, a significant drop in orders, and these are from sometimes national companies or even international companies involving food as well as other products. So I put these pieces of information together with this article from this blog on shipping blog showing the decline in cargo coming into Los Angeles, probably Long Beach, San Francisco, Seattle, Portland, etc., are all similar because, and that is showing up in our economy. So I think we're going to see a slowdown. If we see a slowdown, again, I said earnings. When is that going to hit earnings? And therefore, when is it going to hit stocks? And I would say, you could say it's happening now. It may show up at the end of year. It may show up first quarter, second quarter, or in the last half of the year. We don't know. But I would say at some point that is going to show up and have an impact. Now I want to play a piece from, this is from Bloomberg, and it is on the Chinese economy. This is done out of Hong Kong, and it's interesting because the U.S. is kind of the engine of the world from a demand standpoint. We're consumer oriented. We consume a lot of products, and China is the engine that is on the supply side. So, there are other markets throughout the world, but you'd say China a big indicator, U.S. a big indicator on supply and demand, and so this talks about how China, which was once maybe I think I remember growth was going at 10% per year, or just a given year a few years ago. 10%, that's unbelievable, not sustainable for sure. But China's economy is in decline, in sharp decline, and the economy there, it relates to everything. It relates to their real estate market and employment and other factors. But this is an interesting piece on China's economy.
Chinese second quarter GDP growing at the slowest pace since 2020. That follows the COVID outbreaks, the lockdowns, the country's rolling zero COVID policy. Let's get to our chief Asia economics correspondent with the data and see whether there's anything under the hood that we can take cheer from. Enda.
It's a pretty downbeat set of numbers, Manus. Like you said, second quarter GDP growth, 0.4%, much worse than expected. And that now cements the idea that the government has no chance of meeting its 5.5% growth target this year, something that's politically sensitive in itself. Now, we did have some high frequency numbers for the month of June as well. That showed an ongoing slump in the real estate sector, and the property sector continues to worsen up to, and that accounts for maybe 20% of the overall economy size. And then on the on other parts of the economy, retail spending looked pretty good actually, gained over 3% on the month. But again, people are saying you've got to factor in the impact of inflation there, especially on areas like petrol prices, for example, which is pushing up the overall retail sales number. So, something of a mixed bag on the data. You can argue that the economy is stabilizing. That surely wouldn't be hard given that it's coming out of the major lockdown and restrictions that Shanghai was under for a couple of months there. But I think the bigger picture is still one of so many challenges and so many headwinds facing China's economy, not least from the real estate sector.
Yeah.
The next piece is on food shortages. This comes from an expert in the field of food supply chain. His name is Phil Lampert, and he has been the editor of Food Trends for 31 years, and he's an expert on what is happening in the food industry. He describes what is happening with food shortages in the U.S. and clearly issues, if you think these are the issues in the U.S., the issues in Europe are much worse. If you get all the way into Ukraine and Russia, I think even worse, and you can imagine why. So I want you to listen to this piece from Phil Lampert.
There's a lot of food shortages that are anticipated this holiday season because of our weather, floods, hurricanes, extreme heat, drought, large bouts of rainfall. In fact, the National Oceanic and Atmospheric Administration reports that in 2022, there have been 15 climate disaster events in the U.S. The losses are about $1 billion each. So we go down the list of what products are going to be in short supply as a result of this. We have rice. Obviously, when you're growing rice, you need a lot of water. Most rice comes from California. We have a major water shortage here in California, so a lot less rice. Also, because of the hurricanes in Florida, a lot less citrus. That means a lot less orange juice. Imported orange juice, obviously from Brazil, will still be on the shelves, but that's it. Also, beef. Now, here's an interesting stat. The beef slaughter is up 13%. That's the good news. But because of the weather problems, there's not enough grass or other feed is too expensive for the cows. So they're actually culling the cows, meaning killing the cows because they can't feed them. So we're going to have that problem upon us as well. I mean, we've been talking for a long time here about how climate change is really affecting our food supply, both price-wise as well as shortage-wise. But I think that a lot of people are going to be very disheartened as they walk in the supermarket over the next few weeks during the holiday season and really seeing these shortages again. We saw them in the beginning of the pandemic. People freaked out. I don't think people are going to freak out now, and stores are doing a great job to avoid that by fanning out products on a shelf so we don't see empty shelves. But still, I think it's a major problem.
In the Wall Street Journal, there's an article, again, the same theme of what we're talking about. That's why I wanted to give you some documentation on what I had said of what I see coming. Retail sales, manufacturing declines point to a slowing economy. No surprise. We've talked about why retail sales are down and manufacturing is down, whether again, it's from the supply of parts or materials, or it's on the demand side. I see it's probably some of both, but as that declines, that will show up in stock prices. And finally, I'll give you a piece of good news. Actually, this is kind of good news and bad news, but you can see it both ways. And this is that the jobless claims are at an all-time low. So the number of people who are out of work is less than has been in a long time. So I see that as positive in one sense, but the other sense that maybe it has a negative twist to it is that it's with demand for workers, it is going to push wages up, and which is good for the workers, but it's probably bad for earnings, and it's going to put a drag on the economy as well. So it's a two-edged sword. You can see it both ways. And then finally, I want to show you the flow of funds report. Money is going out, no surprise from what I've told you, money is going out of equity funds, going out of bond funds, and into money market funds. And we recently took all of our client accounts that we manage to money market funds, or basically money market funds. And so, I don't know, what percentage of people are doing that, but that's what we did. And of course, we did it mathematically. But the report says, and this is a report from, it comes out on December 14th, but it's from data. The first two are from data derived on December 7th. So the data is actually from the time I report it is almost 2 weeks old, but it's the closest we have to data. Equity funds showed an outflow of $22.7 billion, and bond funds showed an outflow of $7.5 billion. Money market funds showed an inflow of $22.6 billion. And this data is actually it's only a week old, not 2 weeks old. So I want to wish you a Merry Christmas and happy holiday season. Thank you for watching. If you have comments, leave them in the comment section below, and I will try to respond to them. Thank you very much.